Welcome back to the deep dive. Okay, and today we're digging into that recent Q3 fiscal 25 earnings call. Our goal here is pretty simple. Break down the results, what's behind them, and the big strategic moves they talked about. Give you the quick version of what you need to know.
Yeah, and the story coming out of the call, it was pretty positive overall. I mean, look at the market reaction initially. It tells you this quarter, strong execution, real profitability leverage showing up, and they position things well for the holidays.
Okay, let's unpack that right away, starting with the financials. Revenue, $28.2 million. That's up 35% year over year. Solid, pretty much in line with consensus, maybe a touch under the high end.
Exactly. But like I said, the big story, the thing the street really reacted to was the bottom line. EPS, both GAAP and non-GAAP adjusted, came in at 9 cents. That blew past expectations. Consensus was more like, 5 to 7 cents?
Yeah, significantly better. And it wasn't just a small beat. This looks like real operating leverage finally kicking in. Net income more than doubled year over year, $2.2 million versus just $1 million. Adjusted EBITDA almost doubled too, $3.7 million compared to $1.9 million.
Right. And if you saw the stock action right after the numbers hit, it jumped. That tells you the market was rewarding the profitability, rewarding the confidence in future earnings. Any slight worries about the revenue range or, temporary margin stuff, they were basically overlooked.
Okay, let's dive into those drivers then. How did they get that 35% revenue growth? And you mentioned temporary margin shifts. Let's talk about that too.
So the growth, a lot of that was driven by their expanding footprint, physical stores. There are over 1,000 stores nationwide now. So strong dealer sales, chain store sales, that physical presence was a big factor this quarter.
Got it. But I want to circle back to digital too. They really highlighted that AI ad campaign, the "We Don't Sell Bananas" one, right? Sounds like that really moved the needle.
Oh, absolutely. A masterclass in getting attention. They said average daily web sessions went from around 33,000 before the campaign to over 50,000 in August, then up again to 58,000 in September. And they even mentioned hitting peaks of 70,000 sessions a day recently. Huge surge.
Wow. Okay. So tons of eyeballs. But you said that came with maybe some margin pressure.
Yeah. A slight dip in the near term. Gross profit margin landed at 60%. That's down from 62% last year. Management pointed to two main reasons for that compression.
Okay, hold on. Temporary compression. That sounds like something management would say. A 2% dip isn't nothing when you're launching new stuff and spending on ads. Did they give solid reasons why this isn't, a permanent hit?
Fair question. They broke it down. First, channel mix. More sales going through dealers and international partners this quarter. Those channels just have lower margins than selling direct to consumer. Second, they called out one-time startup costs, specifically for the new compact launcher, the CL, ramping up manufacturing for that, plus the new ammo facility they built.
Ah, okay. So it really hinges on them getting more efficient as they scale up those new operations.
Exactly. And that's where the AI story gets more interesting than just ads. Management sounded very confident about getting margins back up, targeting 63 to 65% next year. And the why behind that confidence, they talked about using their own in-house AI systems. AI they built themselves for managing the shop floor, optimizing yields on the CL production, boosting efficiency. So it's not just AI for marketing sizzle. They're baking it into the manufacturing process to hit those margin targets. That dual approach AI for customer acquisition and for factory efficiency, that felt like a key insight from the call.
That makes sense, and it leads right into the bigger strategic picture they painted. Sounds like they're trying to reposition the whole company, right? Moving beyond just selling the less lethal devices.
Becoming more of a broader personal safety platform.
Yes, exactly. Which tackles a fundamental business challenge. How do you smooth out sales? These kinds of products can be seasonal, cyclical. So how do you build a steadier relationship? That's where ByrnaCare comes in. Right, the new service plan, designed specifically to bring in recurring revenue, keep customers engaged longer, increase that lifetime value, and reduce the reliance on, say, just holiday sales spikes.
They said early adoption is tracking with their expectations. That's positive, because if they can successfully convert a good chunk of their buyers into subscribers, well, that changes how Wall Street looks at the company. You start getting valued on recurring revenue multiples, not just volatile hardware sales.
And they're pushing the brand image too, sounds like, using bigger media placements.
Yeah, they mentioned ads on MLB streaming, NFL displays in airports. It's all about making the brand more mainstream, building credibility, normalizing the product. That helps pave the way for this platform idea, makes it feel less niche.
Okay. And what about the actual products right now, the mix?
Interesting split there. The new compact launcher, the CL, seems to be doing better in actual stores, brick and mortar, where people can handle it, try it out, experiential retail. But the older FD model still rules online. Places like Amazon, where it's got history, reviews.
Got it. So that brings us to the future roadmap. What's coming in, say, 2026, 2027, seems tied to that platform idea.
Absolutely. The big one is rolling out a connected safety platform, integrating SOS alert features into the devices. Could be through add-on components, maybe built right in eventually. And this isn't just a feature add, it's a whole business model shift again.
Explain that for us. Why is connectivity such a big deal here?
Well, think about it. Once the device is connected, it's not just a one-time sale anymore. It potentially becomes a subscription service, like your home security system, right? That's the holy grail. Reliable, recurring revenue. Wall Street loves that stuff. Plus, it could really broaden their market. Think about firearms owners. Maybe they want a less lethal option, but they want it connected, maybe integrated with systems they already have. This could open up a whole new customer base for them.
And they're also looking down market, a cheaper launcher planned.
Yeah, mentioned a 61 caliber launcher. Lower price point coming in 2026. Make it more accessible for budget-conscious buyers. Expand the reach that way, too.
Okay, so lots of plans. How's the balance sheet look to support all this?
Pretty healthy, actually. They've got $9 million in cash and securities. And importantly, no debt. Current or long-term. That gives them flexibility to fund this growth internally. Inventory is up, $34.1 million. Looks high at first glance. But they framed it as strategic, loading the pipeline for the holidays. Expect it to normalize early next fiscal year, FQ1 26.
Makes sense. And what about guidance for the rest of this year, FY25?
Still confident. They reiterated the full-year revenue growth target, plus 35% to plus 40%, but they did flag that timing issue around Black Friday, Cyber Monday.
Ah, the classic Q4 versus Q1 question.
Exactly. Since those big sales days fall right around the fiscal year end this time, when the actual order ship could push sales from Q4 into the first quarter of fiscal 26. Just a timing thing, but something to keep in mind for near-term numbers.
Okay, so we have this interesting setup, a strong long-term story, this platform shift, recurring revenue potential. But near-term, there's some uncertainty. Margin recovery progress, holiday timing, converting all that web traffic. All right, let's shift gears. If we were putting on our hedge fund hats for a moment, and obviously, quick reminder for everyone listening, this is just an analysis, an idea based on the call, definitely not financial advice. How might someone construct an outrageous but plausible trade around this specific situation?
Yeah, it's a setup that kind of begs for a more nuanced approach. You might believe in the long game, the margin recovery, ByrnaCare taking off, the connected platform, but you also have to respect the short-term noise, that holiday timing risk, the uncertainty about how many of those 70,000 daily web visitors actually convert this quarter. The market's waiting to see proof.
So you want exposure to the upside, but need to navigate the next few months of potential chop.
Precisely. So maybe you look at a volatility play, something like a long-dated diagonal call spread, with the basic idea. You buy the future potential relatively cheap and use the short-term uncertainty premium to help pay for it.
Okay, lay out the mechanics. How would that work?
So you'd buy a call option pretty far out in time. Let's say June 2026 expiration, maybe targeting a strike price that reflects success with the margin recovery and platform launch. Then simultaneously, you sell a shorter-term call option against it, maybe January 2026 expiration at a higher strike price. The premium you collect from selling that near-term call helps offset or maybe even fully covers the cost of the long-term call you bought. You're basically betting that the near-term uncertainty keeps the stock range-bound or only moderately up for a bit, allowing that short call to expire worthless or be managed, while still holding that cheaper long-term ticket for the big strategic payoff if it materializes. It lets you play the long game while respecting the near-term fog.
Interesting. A way to define your risk while still capturing that potential longer-term re-rating. Okay, good stuff. Let's wrap this deep dive up.
Sure. So key takeaways from Q3. Definitely the strong profit performance, that leverage kicking in, confirm the top-line growth 35% year over year. But the really big picture takeaway, looking forward, is that strategic pivot. Moving from just selling a device to building a whole safety ecosystem. Recurring revenue, connected features. That's the future direction.
So final thought for you, the listener, as you watch this unfold.
Well, management kept bringing up how they used AI internally to build their point-of-sale system, their factory management tools, claiming it helps them move faster. So the really big question now is Can that same internal AI capability speed up the next phase? Can AI accelerate the development and, critically, the adoption of that new connected safety platform? Could it pull that recurring revenue stream forward, maybe making it a bigger factor in 2026 rather than just 2027? That's something to think about as you monitor their progress and look for updates on that roadmap.
Excellent point to end on. That's all for this deep dive. Thanks for joining us, and we hope you feel fully up to speed on the latest.